And I'm going to talk to you about new legislation. If you've already looked at these, you know there's a whole lot of slides in here. I kind of lost count at some point. We're not going to get through all of them, but I did want to keep them in so that you at least have some reference to them, but I'll try to go over as much as we have time for. Some of the information Courtney went over yesterday, so you've already heard some of it. We won't go over that again. Okay, so this is on Senate Bill 128 on regional infrastructure. So this slide, as well as the next two, provide information on a new infrastructure revolving loan at the state. The revolving loan program itself is overseen by the state budget agency, but they're going to move it under the under IFA, which oversees which I don't know, counties really have a lot to do, but that revolving loan for drinking water and wastewater. They're now going to have this regional infrastructure as another source of funding, and of course this is for improving local highways, roads, and streets. So you probably don't have a lot of dealing with it yet. I just want you to be aware that it was there, and it may be another source of getting funding for your county to work on those projects. There is a provision in this which is for this that not sure how many places it is, but it does allow a provision that if you are notified by the Indiana Finance Authority, IFA, that a local unit has failed to pay the principal and interest payments for this regional infrastructure, as well as the wastewater, drinking water, that amount can be withheld from their tax distribution. So you just need to be aware if they would contact you about that for one of your local units that is participating. This one really talks about the order of the funds that you're going to withhold it from. Again, it's just general information on that. And the third slide talks about the Northwest Indiana Regional Development Authority and other redevelopment authorities. And there's some changes to to those laws. This one particularly oversees projects on regional transportation, highways, rail lines, airports. And again, there's some local funding that you can have for the redevelopment authority that can come from your general or rainy day funds. And again, there's just this information on it. You may or may not run into this. Okay, Senate Bill 152 was on local redevelopment. The first thing it did was it eliminated the blight registry, so that is no longer on the website. That had been operated by the Homeowner Protection Unit. It was a mechanism you could use to determine who should not be eligible to participate in tax sales, and they were no longer going to have the blight registry. The Homeowner Protection Fund still exists. The source of the funding currently is $2.50 of the $3 fee assessed whenever a mortgage was recorded. Under the new fee for recording documents, which we'll talk about in a little bit, and you're probably aware of, they went to a flat fee schedule instead of the individual fees. But there is still going to be money collected that's going to go to that Homeowner Protection Fund. They also added that 100% of the automated record-keeping fee collected by the clerks from pre-trial diversion programs is going to be sent to the state for that Homeowner Protection Fund. And city court clerks will be collecting from their deferral as well, which they don't run through you. The money that's collected for this goes into that State Remittance Fund 7108 on your chart of accounts, so you know what I'm talking about with that. It also added under the redevelopment statute under 36714 that if a parcel of real property is not being sold in an auction, or if the total purchase price of the land and structures exceeds $25,000, then the redevelopment commission must get 2 independent appraisals, and they cannot exceed the average of that. But the flip of that is if it is being sold at auction, or it's less than $25,000, they do not need to get those appraisals anymore. So it is changing how they're able to purchase real estate. It's also adding for your redevelopment commission that they can purchase property that is blighted unsafe, abandoned, foreclosed, or structurally damaged from any willing seller. There are additional procedures in the statute that they must follow to do that. They may also purchase property from another governmental agency if they have sufficient funding and the price is less than that $25,000 threshold. Again, if the sale price is more than $25,000, they have to get the two separate appraisals and use that average. The title or interest in the property is to be conveyed to the city or town or county, whatever the redevelopment commission has been established by, but it's in the name of the unit for use and benefit of its Department of Redevelopment. So that's how it's got to be deeded. And I don't know if you ever had to deal with this, but just in case you ever do, there is a law on bovine tuberculosis testing, and under the new law, if you have to do that for your county, the state will reimburse you 50%. So I don't know if that's ever happened that you've had to do it, but it's something you guys to keep in the back of your mind on that one. They did change under the statute that if someone is arrested for a felony, not convicted, but arrested, they are now allowed to collect DNA. That doesn't affect your office that much. It will affect the clerks. But they also changed the fee, and they increased it from $2 to $3. Senate Bill 346 on donation of funds. There have been a couple counties that have dealt with this, and it's the donation of proceeds from the sale of a utility or facility to a charitable nonprofit community foundation, where that foundation is then holding the donation as a permanent endowment and distributes the income from the endowment back to the unit. And under the current law, if the foundation ceases to exist or violates the agreement, then the entire donation is returned to the general fund. This statute now, I think the most common that I've seen is the hospitals. So that's what we're talking about, where they're selling a hospital and getting a significant amount of money. If that money does come back under this new bill, the DLGF cannot consider that, donate that, because we're talking millions of dollars there that they are not using that in determining your maximum tax levy. Okay, Senate Bill 348 is a fairly simple one on sign ordinances. It is affect the home rule law. It limits your local unit's ability to regulate signs during an election, specifically 60 days before the election and up to 6 days after the election. You cannot enforce the sign ordinance for political signs. However, if the sign causes a safety issue, the sign may be regulated even during this time. Okay, Senate Bill 386, Courtney talked about this yesterday, so I'm not going to try not to repeat anything that she said, but there was some additional information in it, and it's dealing with the property tax appeals, the reviews, appeals, and refunds. It is effective July 1st, and she talked about yesterday extends the filing for an application for an exemption on property, so the current deadlines are going to be changed under that. She had a chart on that yesterday, so I'm not going to go over all of that. Okay, it's also changed a lot in Indiana Code 6-1.1-15, and it regarding the procedures for review and appeal of assessment and correction of errors. The first section in that chapter is repealed and replaced by a new section, 1.1. Under the new subsection, a taxpayer may appeal an assessment of a taxpayer's tangible property by filing a notice in writing with the township assessor or the county assessor if the county does not have township assessors. The allowable reasons to file the appeal, and they're listed on this slide. And DLGF will design or designate the forms to be used. There should be a separate petition for each parcel, but it does add these are the reasons that they can file that. And again, this talks about the deadlines of when they're allowed to file that appeal. For reasons 2 through 6, on the previous page, which were, one is the assessed value for all of the rest, not the assessed value, but for all the other reasons, they must file the appeal within 3 years after the taxes were first due. Okay, and it also goes on to say that what that appeal does, it only applies to the tax year corresponding to the tax statement unless the county has taken action regarding a prior tax year that is reflected for the first time in that tax statement. And then there are reasons that a taxpayer may not use this section to appeal, and they're listed on there. When the denial of a deduction, exemption, abatement, or credit, if the authority to approve or deny is not vested in the county board, county auditor, county assessor, or township assessor, they can't appeal to the county on this. The calculation of interest and penalties is not an appropriate use of this section, or if there's any other statute that tells them how they should be appealing an issue. Okay, this also adds a new section under 1.1 for section 1.2, and regarding it kind of formalizes the process about exchanging information. So it does regard the information of exchanging information between the assessor and the taxpayer that you have in the informal hearing prior to the hearing in front of the PETA-BOA. When an official receives a written notice to appeal that we just discussed, the official is required to schedule a time during business hours that is convenient to the taxpayer, a preliminary informal meeting to try and resolve the appeal. The county or the township official and the taxpayer shall exchange information that each party is relying on at the time of the preliminary hearing for their position on the disputed issue. If any additional information is received by either party prior to the hearing, it shall be exchanged with the other party. If it is not exchanged, the hearing may be continued to allow review of the additional information. The official will then report on the results of the informal hearing. If the official and the taxpayer agree on a resolution, the agreement shall be signed by both parties and submitted to the PETA-BOA. If no meeting is held or a resolution is not reached, that will be noted on a report. Again, their form will be provided by DLGF. Then the board will vote to accept or deny the agreement. The hearing will be scheduled within 180 days of the written notice of appeal. Notice of the hearing must be sent 30 days prior to the hearing date to the taxpayer, county or township official, county auditor, and taxpayer representative. They can continue the hearing with approval from the board, or the taxpayer will withdraw their appeal if they give notice at least 10 days in advance. If the taxpayer withdraws, they waive their right to a hearing by the Indiana Board of Tax Review, and then there are a bunch of additional procedures that are in there. It did change the language prior. Currently, the county assessor must assess a penalty if the taxpayer or his representative does not appear. It now says they may assess a penalty of $50 if the taxpayer or his representative does not appear at the hearing and has not withdrawn the appeal or received a continuance. That penalty still may not be added to the tax bill. Okay. In Chapter 15, there was a section on how to do refunds based on these appeals, and that section has been repealed. It is no longer in Section 15. Refunds or procedures for doing refunds is now all found in 6.1.126. So instead of having to go to several locations, they put it in to streamline it. They put it into one chapter. They did add a new section, 12.1. We're still back in 15. This new section requires the auditor to correct errors in conformity with the determination of appeal by the County Board of Tax Review, Department of Local Government Finance, or a court. So if you receive notice that assessment has been, or an appeal and assessment has been determined, you have to follow what those directions are. But it also adds that when an error is discovered by the auditor regarding the description of the property, the identity of the taxpayer, they are able to correct those. They are also able to correct upon discovery errors regarding a tax cap, credit, exemption, or deduction. In addition, they are to correct any errors in the computation of taxes, penalties, delinquent taxes that have been carried forward, or an overpayment if they are discovered. Then the auditor shall notify the taxpayer of the correction of an error for items B, C, and D on the previous slide. If the correction of the error results in a refund, you're going to follow procedures, again, in Indiana Code 6-1.1-26. The taxpayer may challenge the auditor's action under B or C, which, again, B was errors regarding description of property, identity of the taxpayer. C is errors regarding a tax cap, credit, exemption, or deduction. A taxpayer may challenge an auditor's action in regard to the computation of taxes, penalties, or delinquent taxes carried forward as an overpayment, and the procedures for that are found in Indiana Code 6.1-26 and not in Chapter 15. And except for subsection A, which is where you're getting the direction from a board or the court, the correction of an error may not be applied to tax years earlier than 3 immediately preceding years. So it's specifically stating you can't go back more than 3 years. Okay, then it goes on to the changes in Chapter 26. Again, this is effective July 1st. The first section on claims and filing for refunds has been repealed, and a new section replaces it, 1.1. It says a person, including heirs, personal representative, or successors, may still file a claim for a refund under this new section. The claim will still be filed on the 17T. However, we're going to have to make some changes to it because the language on it reflects the older statute, so there will be a little bit of change on the bottom section of that form. For taxpayers that had filed the appeal under Chapter 15 that we just went over, the notice of appeal shall be treated as a claim for refund by the taxpayer and filed as of the date of the final disposition of an appeal by the County Board, Board of Tax Review, Department of Local Government Finance, or a court, tax court. The claim must still be filed within 3 years after the tax is paid or 3 years after the disposition of the appeal. The claim for refund must state that a payment was made in excess of taxes due as established by a determination of the County Board, Board of Tax Review, DLGF, or court, or proof of an error in computation of interest, penalties, or delinquent taxes carried forward, or proof that an overpayment was made. And a taxpayer may not use the claim process in this section, 26-1.1, if the appeal is a matter covered under Chapter 15. A taxpayer is not entitled to a refund if a credit has been applied to later tax liabilities of the taxpayer on the property for which the tax is assessed. So again, this is a Section 2 in Chapter 26 has been repealed and replaced by 2.1. Again, this is effective July 1st. Under this new section, the first step is a review by the county auditor, and the auditor shall approve or deny the claim for refund. If the county auditor approves the claim for refund, then the county auditor shall forward that claim to the treasurer, county treasurer, and county assessor for approval or denial. The county treasurer and county assessor shall each certify their approval or denial, and return the claim to the auditor not later than 75 days after the filing. If all three approve the refund, the county auditor shall issue a warrant to the claimant paid from the general fund, same as it was before. The taxpayer is also entitled to interest on any overpayment of property taxes, which shall be computed from the date on which the taxes were paid or due, whichever is later, to the date on which the county auditor and county treasurer approve the refund. The rate for the interest is the rate in effect, as it has always been under Indiana Code 6-8.1-10-1 for each year covered by the refund. If the taxpayer no longer owns the property on which the tax has been assessed, the county auditor shall pay the refund to the taxpayer or other lawful claimant. If the refund is denied, the auditor will send notice to the claimant, and the claimant may file within 45 days an original action claiming a refund in the court of the county where the property is located. And again, you're going to follow the same, it's in a new section, but you're going to follow the same procedures for if you do file the refund, for withholding that at settlement time and from the taxing district so you can repay the general fund. So again, we're still in Chapter 26, and 26.3 has been repealed, and it is replaced by Section 26-3.1. This new section states that if the determination under Chapter 15, which is the one we went over first, of this article results in an overpayment by the taxpayer during the same year to which the assessment appeal is related, the taxpayer is entitled to a credit in the amount of the overpayment on the next successive tax installment. After the credit is given, the county auditor shall determine if an additional amount is still due, and if so, without claim or appropriation, pay the amount due the taxpayer. If the taxpayer no longer owns the property or is no longer the lawful claimant, the refund shall be paid to the lawful claimant. If the credit is not applied or the refund is not paid within 90 days of the final resolution of the appeal, the taxpayer or lawful claimant may seek a refund under Section 1.1, which we went over, of Chapter 26. And still in Chapter 26, Section 4 has been repealed, and it is replaced with Section 4.1. This section applies to any refund resulting from a property tax assessment appeal before January 1st, 2020. Does not apply to any refund that has been paid by May 1st of 2015. And this is dealing with those appeals that are over $100,000, or if the refund is over $100,000 based on the appeal. So it's moved it to Chapter 26, but still the auditor may, instead of a refund, elect to apply the credits in equal installments to future property tax installments for the property over a period of not more than 5 years after the date of the conclusion of the appeal. Again, the auditor may elect to accelerate the credits or provide a full or partial refund within the 5-year period. If the taxpayer no longer owns the property, a refund may be paid in installments over a period of time of not more than 5 years. And this entire section will expire 12/31/19. Section 5 of Chapter 26 is repealed. Section 7 is added regarding court determination, and it does specify that if you receive a court order, the court is to specify the instructions on how you are to provide the relief. So it should be within the court order itself. And Courtney talked about this yesterday. And it is a change to Indiana Code 6-1.1-37, and it's effective again July 1st. No, this is not what I'm thinking about. This bill under the 10.7 is repealed. 10.7 was what allowed you to do a waiver of penalty in the case of death in a family, of a family member. That has been repealed. It is no longer in the statute. And I'm assuming it's because as Courtney went over yesterday, there is a way for you to do a county policy for negotiating or waiving fees. But the specific statute that requires you to waive fees because of a death in the family no longer exists as of July 1st. And 37 used to have the Section 14 on the appeals in excess of refunds in excess of $100,000. That's been moved to 26. It's basically the same, but it has moved location if you go looking for it. The Senate Bill 402 has to deal with the administration of county homes. The information's on here. I'm not going to go all over that, but it does have some provisions for getting hiring someone outside the county to actually administer the home. Senate Bill 443 is on uniform business organizations. And this establishes a new article under Title 23 on business organizations. Most of that bill applies to the Secretary of State's office, so we're not going to go over it. You just need to know it exists. The only thing it did affect, and I went over this with Recorder on, there is still the requirement for them to record locally in their county on their the name of their business entity when they're using an assumed name. The county recorder will still charge a fee under the new fee structure for each certificate that they give or notice of dissolution. And any fees they charge, they're going to also receipt those the same way they do their other fees. Okay. Senate Bill 449 on your omitted personal property audits. The contract for the discovery of omitted or undervalued property must now include a monetary threshold set by the assessor, and when the non-reverting fund passes this threshold, the excess amount above the threshold must be distributed by the county auditor to the appropriate taxing units. And you will continue to distribute the remaining money once the contract is finished, but there will be a threshold set so that once that fund gets above that threshold, you're going to distribute that money. So the fund, it's just going to put a limit on how big that fund can get. Currently, the statute requires that the contract for services may not be based on a percentage basis. This bill adds language that the contract may not be based in any way on increases of assessed value or property tax revenue that are attributable to the discovery of omitted or undervalued property. And the contract may not exceed 3 years. Senate Bill 455 is the tax administration of mobile homes. This probably affects the treasurers more than it does you, but you do need to be aware of it. Effective January 1st of 18. It expands some of the definitions for what an inventory is, that is for a owner has a mobile home park or has multiple mobile homes on their property. Chapter 7, which is on the taxation of mobile homes within 6-1.1, and Section 3 in that chapter is amended to change the notification deadline to the assessor from 10 days to 30 days for reporting the placement of a mobile home on any land, so it does give the taxpayer a little bit more time. And it adds some information that mobile home communities must provide for their required reporting. This bill establishes an operational procedure by which a county treasurer may sell a mobile home that has been assessed as personal property at auction for delinquent personal property taxes, penalty, and collection expenses. The new chapter is under 6-1.1-23.5. It's an alternative procedure for collecting delinquent personal property taxes on the mobile home. The treasurer may elect to use this new chapter, but whatever election they make, they have to follow through, so they can't go back and forth between the choices. The process itself is similar to a tax sale procedure for real property. Initially, a tentative list is compiled by the treasurer for mobile homes assessed as personal property with those delinquent personal property taxes. And I've got some of the information from that statute on here. I'm not going to go through all of that, but you do have that for your reference. And also on the next slide. Oh, and on the next slide. There's a lot of sections in there. Okay, and as you read through this, you'll find it's very similar to what you do when you have a real property tax sale. It just allows it for mobile homes. It's just another avenue for collecting those delinquent taxes. I don't know how many of this will affect you, but I've already got a call on this, so I'm going to do a shout out on it. And there is, under Senate Bill 456, there is a procedure for the county to move the administration of a war memorial over to a not-for-profit if maintaining it becomes more difficult, but there are procedures for that. And again, I've already had one county call me about doing that, so I guess there is some need out there. Senate Bill 505 was the big one for recorders. We went over it. I went over it rather extensively at the recorders assessment on many slides. So if you want to see a full expanded, you can go onto our website and pull up the recorders meeting materials, and you can see the additional slides on that. I did not do that for you guys because you probably don't need this kind of detail on it. The bill itself was pretty lengthy. It was about 268 pages, but the bulk of it was dealing with replacing gender-specific titles with gender-neutral titles. So instead of saying the auditor in his office, it would say the auditor's office, instead of assuming that every elected official is male. So some of the highlights on this: currently a person can claim a homestead deduction if they are buying property under contract, if that contract is recorded in the recorder's office. But this, under Senate Bill 505, it expands that to include that a memorandum of contract recorded in the county recorder's office will also suffice to allow them to claim that homestead deduction. Okay, it also introduced a new chapter on the title, under the title on property, which is 32-21 on conveyance of real property. And that new chapter is 2.5, which is the Uniform Real Property Electronic Recording Act. I think many counties were already doing electronic, but this actually finally puts it in statute. I did stop, and I'll do it for you guys as well as I did for them. And I realize, as I told the recorders, that internal controls are not your favorite topic of conversation, but unfortunately for all of you, they are mine. So I am pointing out that even though you're already doing it, and now the statute allows you to do it, electronic recording does give you a whole new avenue of risk that you need to look at and address. So because a file looks like it comes from a mortgage company, it might not, and it may contain malware. We've had a county that has more than one county and several small towns and cities that have been attacked by malware. They're opening a file that looks perfectly legitimate to them, and then they get the attack. So you want to address those risks, work with your IT department, figure out ways to address, to prevent those kinds of things from happening. But again, as we move forward, you're going to get more and more electronic information. And so you need to make sure that electronic information is secure before you introduce it to any of your systems. So under Section 8 of this new chapter on electronic recording, it does state that beginning January 1st, 2018, the county recorder who implements any of these functions must do so in compliance with standards established by the Electronic Recording Commission, which was created under Section 9 of this chapter. So they've got until the rest of the year to get those standards in place so they know what they're operating under. This talks about that commission, what it's made of, and what their tasks are set out for them. And again, they need to have this implemented by January 1st of next year. Again, you don't need to know all of this, but they did go to a flat fee schedule, and these are the schedules that were established under statute for recording a deed, any deed or instrument other than a mortgage. They're going to charge a flat $25. For recording the mortgage, it's going to be $55. And it goes on when there are some differences, the size of page and all of that. This is supposed to, again, uniform so that different, if companies that are dealing with more than one county can get an idea of what they're going to have to pay, and it's not going to vary as much where they're calculating it out. It does show you how it's going to be allocated. Of course, the recorders are going to let you know on the report of collections what they've collected and how they're going to allocate it out. But out of the $25 fee, $8 does go to County General, $5 continues to go to the Surveyor's Corner Perpetuation Fund, $10 will go to the Recorder's Record Perpetuation Fund, $1 to the Identification Security Fund, and $1 to the Officers Training Fund. This is for every county except Marion County. And then there is the breakdown for the when they're recording a mortgage. The County Identity Security Protection Fund is a fund on your chart of accounts. This fund was established under Indiana Code 36-2-7.5-11. The purpose of the fund is purchasing, upgrading, implementing, or maintaining redacting technology used in the recorder's office. The fund is administered by the county recorder, but it does require appropriation by the council. This Senate Bill 505 did change the statute for this fund. It allows money in the fund to be transferred to the County Recorder's Perpetuation Fund for uses set out in Indiana Code 36-2-7-10. F, a basic rule, as we keep telling you of fund accounting, is that money may not be transferred unless there is a statutory authority to do so, and this is giving them a statutory authority to move that money from the Identification Security Fund to their Record Perpetuation Fund. Indiana Code 5-20-5 established the Indiana Affordable Housing Fund at the state. The purpose of that fund is to provide financial assistance to low-income families purchasing a home or renting housing. Under Section 15.5 of that chapter, it authorizes a unit that is receiving a grant from the state fund to establish a local affordable housing fund. The county council would have to enact that county ordinance establishing the fee before that fee would ever be collected. As far as we know, only Marion County has that fund and has that fee. The state has not received from any other county. So if you think your county has established that fee or that fund, be sure and let us know because we need to work on that. Senate Bill 505 also related to their Recorder's Administration for bulk copies, and they did amend how their procedures are to be used when they're selling those providing those bulk copies out. So there's some slides on that. The fees are shown on this slide, and again, all of the fees that they collect from this will go into their Record Perpetuation Fund. They are required now to enter into a contract before they can sell under bulk form. Okay. And as I mentioned earlier, it's in several places in this new bill that the memorandum of a contract as well as a memorandum of a lease may be recorded in lieu of the actual lease or contract if the memorandum is executed and acknowledged by the parties and contains the requirements that are listed in this slide. So just so that you know, they can do the memorandum instead of the full contract. Senate Bill 507, which is also effective July 1st, amends the statute on economic development and the reporting requirements for economic development commissions. Senate Bill 515 does allow the county. It gives the county and other local units of government a mechanism to have money withheld from an individual state tax return for payment of amounts of owed to the local unit. So it's another way to try to collect funds that are due you. The procedures are set out in Indiana Code 6-8.1-9.5. This mechanism already exists for state agencies, like with child support payments, but it's been expanded to include the local units. There will be a clearinghouse established that a unit will enter into a local agreement with to oversee the procedure. So they're going to be, that's all going to be set up, so there's going to be specific guidelines to follow. Now this slide covers some of the requirements for the process. As for the priority of a claimant, agencies under the position, you're actually on the bottom of the list. I guess that probably isn't surprising. The state agencies are still going to get first claim to that tax refund. But if there is sufficient amount to pay that, or there are no state agencies claiming of that, you are in the list to claim that money, to get that money from the individual's tax refund. Senate Bill 539 changed the statute on notaries. It's rather extensive. I'm not going over the bill in any detail, just so that you're aware there was if you have a question about notaries, you need to go in and look because the statute was changed. They repealed chapters 1, 2, 3, 4, and 8. They added chapter under .05 that provides definitions that apply. So if you have a question about what a definition throughout the rest of that chapter is, you can go back to that to determine what they're talking about. Under Chapter 14, which deals with the notary fees, it still does include the provision that a public official or a deputy or appointee of the public official may not charge for service of notary in connection with official business of that office. And that was in the old statute. It's still in the new statute as well. Okay, I know you've heard a lot about House Bill 1002, which is on transportation infrastructure, so it's the road funding bill. So this bill addresses road funding, including changes in fuel taxes, commercial motor vehicles. Some of the provisions do impact you locally, directly. For the county excise tax and county wheel tax, it makes changes to the deadline needed to adopt an ordinance to increase or decrease the amount of tax, and Courtney went over that yesterday. You now must send a copy of your letter of your ordinance. You must now send a copy of the letter from NDOT approving the county's transportation asset management plan, along with a copy of the ordinance to BMV. And I think Kathy went over that a little bit when she was talking about the grant. If the ordinance is adopted, this will affect, by September 1st, this will affect collections for the following year. They changed how the collections in the motor vehicle highway fund at the state will be distributed to cities and towns and counties. It also added the provision that 50% of your motor vehicle highway must be spent on construction, reconstruction, and maintenance of the county highways. So you have to be able to show us, when we come out to audit, you're going to have to be able to document that you've spent at least 50% on the construction, maintenance, and reconstruction of highways, improve those local roads and streets. And we will be sending out some guidance on that. I think they're working on the memo now. This bill, not the right one. Okay, this bill also made changes to the local road and bridge matching grant, which Kathy talked about yesterday, the community crossings grant. The biggest change, and I think the most helpful, is the source for your local match. If you remember last year, when the guidance came out, it had to come out of your special LOIT, your rainy day, or your increased wheel and motor vehicle excise surtax, and there really were only two last year that it could have come out of. And we sent out a memo to give you accounting guidelines to follow so that money was in the rainy day. We had all those restricted funds in order to protect those funds but still get them in the rainy day so they can be used for that local match. You don't have to do that anymore because it can come out of MVH, local road and street, bridges, for bridges. It can come out of your existing funds as long as those funds are legally allowed to be used on road projects. Your local match can come out of there, so there is no need to move that money over into any restricted funds. If you have money in those restricted funds currently, you can either move it, you can either use it for the local match because it's still in rainy day and move it to your grant fund, or you could just return it, probably the easiest, just move it back into those funds because they can be used directly from those funds. So restricted MVH can just go back to MVH. Restricted local road and street can just go back to local road and street. And note that the rainy day fund is still a source for your local match, and any special LOIT distribution is still, that special LOIT fund, that if you have money left in that 1229 fund, it is still can be used for your local match. And just as a reminder for those restricted rainy day funds, you cannot disperse from those restricted rainy day funds. You can only transfer either into the grant fund or back to their originating fund. So that's why I'm saying it's probably easier just to move it back where it came from, unless you have a specific, you've already been approved for a grant, you need to move it into the grant fund. Okay, and the second big change Kathy talked about yesterday for the smaller communities. If you are a county with a population of less than 50,000, again, you only have to have 25% of the match for your project. So it does give you more opportunity for funding within this grant. House Bill 1009 mostly dealt with schools, but it did change a provision on these gap reporting requirements. If you are issuing bonds, prior to this there was a schedule for phasing in on this, and now it is, instead of phasing in, it's just lumped all of the counties again all together. If your county has a population of greater than 100,000, or any municipality with a greater than 75,000, you may not issue bonds after June 30th, 2020, unless your county or municipality has had for its preceding budget year prepared an annual financial report using modified accrual basis of counting in accordance with GAAP. So it just moved that implementation date back for some communities. So it's the same for others. House Bill 1031 is effective July 1st. It amends Indiana Code 511 5, on the report of examinations by the State Board of Accounts. And it adds a section on addressing audit examination comments. So currently, as you're all aware, we come out and do your audit or examination if we find instances of non-compliance that we feel are material enough to be reported. We do report those in your audit report. We go over that with you at the exit. You have the ability to make an official response to that. That all stays the same. But what has happened probably more than once is that some audit findings that we find are repeated year after year. And this new statute addresses that. Under the federal findings that we gave you, you always had to develop a corrective action plan, so you are familiar with that process for a correction action plan. But under this new bill, we're introducing steps where you have to implement a corrective action plan for your non-compliance findings within your audit report. So if we have an examination or an audit report has a finding that you have failed to comply with the Uniform Compliance Guideline or to comply with a specific law, you are to take action to address that audit finding. If we come in to do an examination or audit subsequent to that report, and the same or substantially similar exception to the previous one, what was noted in the previous report, then you are required to file a corrective action plan as a written response. So for the first time it's reported to you that there is a non-compliance, you need to address that comment, but you don't have to have a formal written plan at that time. During the second audit, if the condition continues to exist, then you will need to write a formal corrective action plan. We will be providing guidance on how to establish those corrective action plans. We'll also be providing future training, so I'm sure you're going to hear about this in your fall meeting. Under the statute, after the corrective action plan is filed, the officer would notify, they have 6 months to correct the noncompliance. When the correction has been made, then they must notify Board of Accounts that it's been corrected. We shall review the corrective action plan and what was implemented. If the plan is not implemented or the issue is not corrected within the 6 months, we will prepare a memorandum that summarizes the report findings, what the corrective action plan was, and the manner by which the finding was not addressed, and a recommended course of action. That memorandum is presented to the Audit Committee, which is a subcommittee of the Legislative Council of the Indiana General Assembly. The Audit Committee within statute has several options to deal with the memorandum. They can request a written statement from the public officer that was audited. They can request the personal attendance of the public officer at the next committee meeting. They can request that the public officer take corrective action. They can notify the Office of OMB for state agencies or the fiscal body of a local government or the DLGF for an audit that an audited entity refused to correct the audit entity's failure to observe a uniform compliance guideline or comply with a specific law. They can refer the facts for investigation and prosecution. They can recommend that the legislation be introduced to General Assembly to amend any statute in which the audit entity is found to be non-compliant. In other words, if the law itself they need some clarification of that going forward. And they can recommend that State Board of Accounts examine the entity within the next calendar year following the year in which the unit was required to file a corrective action plan. Courtney spent quite a bit of time on this, and I'm not going to go over the definitions that she had yesterday because you're already aware of those. The House Bill 1043 does make changes to the petition and remonstrance process. The one thing I wanted to point out, as what Courtney was focusing on, is if the county is issuing bonds, they have to follow all of that. If a political subdivision is within your county is issuing bonds, the petition and remonstrance is still handled by your voters registration office. The auditor is only really brought in during the certification process if the voters registration is not able to certify that 525, at least in the phase one, that at least 525 of the signatures are valid in voters registration. Then they turn that list over for the county auditor to look and make sure they are. If they own property that would make them a valid signature. It's really not it's not your responsibility to determine whether or not it's a controlled project. So if the citizens are talking to you, you can refer them back to the unit that is proposing the controlled project, or if they have questions, they can contact DLGF on this. I'm going to go over this, or skip over this, because of the change in the local income tax we're going to talk about. We're going to have a round robin, and Courtney's going to talk about that this afternoon. And I'm running out of time. Okay, House Bill 1272, just so you know this exists, it did add a subsection in case you submit something to a newspaper to be advertised and they fail to do so, what you can do in place of that is considered a valid publication of notice, so that you know that I have had questions on that in the past, so it must happen at least once in a while to you. Okay. Under current statute, the fiscal body must approve any sale of real property that has an appraised value of $50,000 or more. The new bill under House Bill 1295 amends the statute that the county council can adopt an ordinance to increase that threshold amount that would require their approval. And currently, the county can offer real property to the abutting landowner if the property is appraised at less than $15,000. And again, the council can adopt an ordinance to increase that threshold before it requires their approval. It's their option. This was House Bill 1394 was another amendment on home rule. I'm not sure how often this affects your county, but the information is up here for that, and it's on if you have a fee for occupational or professional licensing. And the second one is also on some changes to the home rule statute. And Courtney talked about this yesterday about uploading contracts. And, she talked about this as well. This goes back to where I was saying that the requirement to waive the penalty if there is an immediate death in the family was repealed. I think this is what will address that in the future. Because it does allow the county to establish a policy to waive or negotiate or settle these penalties. I don't know how this is all going to work out when you implement it. You need to be sure. I couldn't recommend more that you have some sort of policy going forward, and you stick to that policy and make sure your residents are aware of that, because it can be a very gray area here, and you want to make sure that you are treating all of your citizens consistently. So you want an established policy when you will waive, negotiate, or settle, and under what conditions, and get all of that approved. This affects more your clerks and sheriffs, but within House Bill 1450, they did change the service of process fee, and that's a fee that goes to the pension trust fund. It was $25, it's now $28. The big change was it's no longer, currently in statute, it's collected by the sheriff, and this does change that it will be collected by the clerk. 1450 also had a section that amended the drainage law, and I know that's all your favorite topic of conversation as well. It did make a change, so if you have a construction or reconstruction project and you are going to finance that project with a construction loan, so it's less than the 5 years, you're not doing the bonds, but you're doing the construction loan, the section that allows the, or requires the auditor to assess a 10% interest fee if the deferral of the payments over the 5 years. So if the taxpayer elects to defer it over, you charge 10% on the unpaid amount. If that is financed by a construction loan, you cannot charge that 10% fee. The statute also allows you to establish a construction loan fund. Currently, I think the statute requires that proceeds from the construction loan as well as proceeds from the bonds go into the general drain improvement. We did set up, now I'll say it wrong, to the 2600 fund so that you can, to give you an accounting mechanism to account for it. I think you could just use those funds to set up your construction loan funds, put your proceeds in, pay for your project, collect your assessments, pay off the debt through that. Where are we at on this? Okay, we're almost out of time because it's lunchtime. Okay, 1491 on excise tax. It really, it changes the title, I think because it's getting very confusing, and I don't know if this clears it up a whole lot, but there's an excise tax that's charged when you get your license. It used to be a license, vehicle license excise tax. It is now just called the vehicle excise tax. The motor vehicle excise surtax that is adopted by a county is now going to be called the county vehicle excise tax, and if it's adopted by a municipality, then it's going to be called the municipal vehicle excise tax. So there's 3 different places that can, the state enacts the annual license excise tax, the county, and then your municipality. And I hope this helps somebody, because I thought it was kind of exciting. On the boat excise tax, currently, if the boat is destroyed, they can come to the county auditor for a refund. Under this new bill, House 1491, that goes into effect July 1st, they do not come to the county for that. They will go to the Bureau of Motor Vehicles and they will get a credit or possibly a refund, but they no longer come to the county for a destroyed boat. So you no longer have to do that or deal with that. You could just send them to Bureau of Motor Vehicles. So that I hope some out. So I've had some calls on this in the past, so I know there have been people coming in to try to claim whether they sold the boat or the boat was destroyed or whatever. Now you just send them back to BMV. It does not come through the county. The House Bill 1536 is on the tax sale certificate, and it gives you procedures for assigning that to another political subdivision. And it changes the redemption period. It shortens that if you do that. And the last slide, and then lunch, on roll call votes. This is House Bill 1622. So this is also effective July 1st. For counties with a population of more than 100,000 that maintains an internet site, the county auditor shall post on the county's internet website the roll call votes of the county's executive body and the county's fiscal body not later than 3 business days after the following has happened. The date the roll call is taken, if the software can generate that report, or if the software is not able to generate the roll call vote, the date the executive or fiscal body are first able to meet and sign off on the vote itself. You do have to maintain that vote information on your website for a period of 4 years.